Today's topic is globalization. And globalization, in short form, is international connectedness, especially from an economic perspective. And we think that right now is a great time to have this discussion. We've assembled a kind of an august team of thought leaders to have the discussion, and we are really excited to talk about a couple of things. First is a little bit of history of how globalization came about, what are the strengths and weaknesses of globalization, and then where are we headed with globalization over the next few years and maybe even beyond that. But we also want to talk about solutions, and I think a big part of this is we all know the challenges that we face that have been sort of exacerbated by COVID, been exacerbated by the war in Ukraine. But there's a lot of potential opportunities for people to come together, people, countries, policymakers to really think about what are some solutions to this, to the challenge we have in front of us. Our panel here is to talk about what are the strengths and weaknesses of globalization, the way it's unfolded. The next panel will be discussing the solutions. So for this panel, again, it's really more on what's happened with globalization, where we had it. And with us today, we have Steve Englander, who is from Standard Chartered. We have Joyce Chang from JP Morgan and Damian Sassower from Bloomberg. We're thrilled to have all you guys here. So what we'd like to do is let's start off with, Joyce, if you don't mind giving us a little bit of historical context on how globalization has come about than that in the past couple of decades. That would be a great place, I think, for us to start.
Well, it's great to be with all of you in person, and what a day with the Fed meeting earlier, and just wonderful to be with Steve and Diego as well. So, what is globalization? How do we define it? So we define it as, the fading of national borders, increasing flow of goods and services, capital, people, companies, basically ideas going across national borders. And globalization in trade and finance really went into hyperdrive in the 1990s. And that was with the creation of the EU single market, the euro, followed by China joining the WTO in 2001. And I would just have to say that I think the suggestions that globalization is dead, the rumors of its death, are greatly exaggerated. And it also is not something that I would blame on Russia, Ukraine. What we've had is that globalization had really plateaued and has been in a range over the last 15 years. So you had this huge growth of globalization trade intensity that really grew dramatically from 1990 to 2010, and that boosted productivity and product margins. But then the first wave of global deglobalization, or why globalization stalled, was in part because you saw some of the wage differential between emerging markets and developed markets collapse a bit. You also saw that emerging markets got better at making their own products in their own domestic markets, and you also had some of the sanctions and things that had started coming about in that time frame as well. But I would say it's a stalling of globalization. Now, the key beneficiaries have been many of the emerging markets countries, the multinationals, but the debate has been, did this boost developed market growth, and did it worsen inequality? And that's kind of where we're sitting at today. But I think that just listening to Glenn talk about Huawei, I mean, you can really see in looking at the numbers for China just how much globalization did as far as the impact of China. In 1980, China was maybe 3% of the global economy, 18% now. If you take a look at our forecast, we have China matching the size of the U.S. economy by the end of the decade. And you could really see just the growth that China became the largest recipient of foreign direct investment, and the largest trade partner as well during that period.
That's great. Thank you so much for the summary. That's excellent. So let's take a step back. I mean, obviously, globalization, as we know it, has clearly produced lower prices and a lot of innovation around the world. It's also probably raised the quality of living for a lot of people, particularly in Asia, out of poverty into kind of a middle class lifestyle. It's also raised GDP, but there's been some negatives as well. Why don't we go around the table here and talk a little bit about what you see as sort of the positives and the negatives. I mean, we think about it in terms of societies, in terms of geographies, in terms of industries. And why don't we start with you, Steve, and just give us your kind of high level on strengths and weaknesses.
Yeah, well, thank you very much. It's a pleasure to be here with you. Look, I think that one of the things that economists know that normal people don't know is that productivity growth is good and trade is good, even though in the short term, both can lead to job losses. What normal people know that economists don't know is that those theories only work if the people who lose their jobs in the short term ultimately find jobs over the medium and long term, because none of this works if it's a permanent effect. And I think that the debate, there's no debate with respect to the, say outside the developed world, that the parts that benefited from globalization benefited a lot. If you go back 60 years and read what was, or see what Hong Kong was like, what Southeast Asia was like, and the difference now, it's night and day. And this has been a real contribution to global welfare. You look at what's happened to the U.S. I'd say that there's a tendency to, hard to say, romanticize factory work here. I mean, I had my first job at 15 in a clothing factory in Montreal, and that was no fun, especially because they were paying below the minimum wage. I mean, which remarkably, and you take a look at the sort of metal bashing jobs that used to be considered like the elite of manufacturing. I would venture that most workers are much happier selling a car than bashing the metal to make a car. It's very different, and so I think that there's, over long periods of time, most people find jobs. Almost everyone finds a job. I think that there are pockets where that job losses can remain for a long time. Now, I'd say one thing that kind of is not well appreciated, certainly in some parts of the Republican Party. It's contradictory not to like trade and not to like immigration, because basically if you stop trade, what you're doing is you're increasing the incentives for legal and illegal immigration to occur, because basically the differentials in terms of wages across regions and standards of living across regions are so enormous that that everyone wants to migrate from the poorer regions to the other to the richer regions. What you see, I think, is that the were you to have trade, I mean, one of the outcomes of trade is that wages get equalized and standards of living get equalized. And I think they put it this way, 60 years ago, I think there would have been a line of people who would want to move from, Korea, Japan, Taiwan to the United States. Now they don't, or, some do, but some don't. I mean, it's not needed because you can live a good life outside of the G10, outside of the, or what was the original OECD. So I'd say that, the last thing I'd say is that there are visible and non-visible benefits. If you take a look at what, say workers, lower part of U.S. working class can consume because prices, or say up to 2019, 2020, because globalization was reducing prices of tradable goods, what you could buy at a dollar store was amazing. And what you could buy for almost nothing is amazing. And I think that to sort of, the old days, people would complain about the minimum wage, and, when it was the national minimum wage was $7.50 or something. But I would walk past the, key foods and see, chicken legs at 69 cents, pork at $1.29, beef at 89 cents. You could feed a family for 2 days on 1 hour's work and what was an inadequate minimum wage. And so I think that benefit is something that has to, should be factored in, even though it's often quite hard to do. But I would say, if you look at the discussion that we're having, like every hour, every day now, on the impact of inflation, I think that brings to the foreground exactly how much the working class did benefit from the price reductions that came across because of the increase in trade and globalization.
That's great. Thank you so much. All right, so Joyce, we're going to give you the challenge of identifying some of the negatives and maybe some of the groups that were disadvantaged, that didn't participate in the benefits from globalization. You can talk about positives too, but let's talk about some of the negatives as well.
Well, I think that globalization really helped the emerging markets, multinational corporations. But I think from developed countries, they didn't see some of the higher growth at the macro level play out. Even though I think, as Steve very rightly points out, I mean, this brought down the cost of many goods. But that headline growth was not achieved during this period of the great moderation that we're coming out of right now. And so I think that's what the debate is, that it actually increased the inequality. Did you basically not achieve the type of headline growth rates, in the developed markets? And then there is, of course, as Steve had mentioned, just, what did this mean for displacing workers as, productivity increased in other areas, labor was replaced by cheaper labor, overseas. But I would, just have to say that, if you do take a look at where we are today in this debate on deglobalization and what we're looking at today with the Fed, and if we're going towards deglobalization, we're going towards higher inflation to stay, because the premise for economic efficiency is that you go to the lowest cost producer. So if you're not going to use that as the criteria, and you really are going to say it is more on the defending your own supply chain, and therefore not necessarily going with the most efficient supply chain, that's a world where you will be looking at higher inflation to stay, and probably shorter and more volatile cycles, which is what higher inflation brings. So part of this was the great moderation. Brought stability, but it didn't bring some of the high growth that it was hoped for.
All right, so Damian, so now you had pro and con. Put those in balance for us. So how would you weigh the benefits and the negatives from globalization in the past?
If you're looking to me for balance, you're not going to get it. Because, look, I mean, the way I look at globalization is simple. I mean, it's undisputable, the benefits of globalization. And, my colleagues here have mentioned them. I mean, if you look about China 25 years ago, it was still chalk on a board at the stock exchange. Look at where we are today. So undisputable globalization works. It's great as long as there's a credible medium of exchange that allows you to reap the benefits of globalization. I think that's where we are today with King Dollar. I think that's where we are today with hard currencies. And so to your point, in terms of the negative impact of globalization, well, I'll give you a list of them. Sri Lanka's in default. Pakistan has to approach the IMF for a restructuring of their loan. Nigeria and Kenya are going to have to devalue their currencies pretty significantly. El Salvador just issued a Bitcoin bond, so, I mean, there's a lot of economies out there that are obviously not only operating along the frontier. We can talk about Egypt. We can talk about Turkey till we're blue in the face, Argentina. I mean, the fact of the matter is a lot of these economies have a lot of debt on their books, and they're going to have to pay them off. And a lot of that debt's denominated in a currency that they really can't control any longer. And a currency, quite frankly, that is becoming more and more expensive with every waking hour, given the environment we're in. I thank you all for joining us here during Powell's press conference, which is, obviously pretty significant. But the reality remains, we are all chasing King Dollar right now. I mean, I'm an emerging market strategist, so I'll be the first one to tell you, it's going to be a tricky environment for investors there. And globalization is having, dare I say it, as quickly as it helped rise a lot of these economies up from where they once were, it's a two-way street, right? It can really plunge you into a very dark place in short order. And I think we're witnessing parts of that. I mean, evidence Sri Lanka. So, for me, I kind of follow the plumbing of the markets. I think, that's where the focus has to be right now. And so, for me, with financial conditions tightening and liquidity being sucked out of the system, it's going to be a real challenging environment. And economic autarky, which is what you're talking about, the onshoring and reshoring of supply chains domestically, is a very expensive order that's only going to fuel the fire and fan the flames, in my opinion. So yeah, it's going to be a challenging environment, Jim.
Sorry, so we're clearly facing a time of deglobalization, right? And that can take many different flavors, but the range of deglobalization can be from as simple as something as basic as it's sort of window dressing. There's a lot of politicians saying it's going to happen. The reality is it's because of the entrenched supply chains that are there, not that much changes, to something like going back to the 1930s, right, where the world was a very different place. Everyone was a protectionist environment, and we all know what happened after the 1930s. Not a pretty picture. So there's a massive range, and a lot of things are also kind of going down kind of quietly with companies. You look at an Apple, you look at a Microsoft, and what they're doing in terms of diversifying or kind of creating some redundancy in their supply chains. A lot of this stuff does sort of happen quietly. So there's a massive range of things that can happen. Obviously, globalization, the one thing we all know is it does tend to be highly deflationary. We're in a highly inflationary environment. The pressure, as we saw today with the Fed, who's reacting to the pressure, 75 basis point move instead of 50 basis point move. They're trying to control inflation. If we're heading into a deglobalized environment that, by definition, almost to Joyce, to your point, creates inflation, then how do you deal with those two dichotomies? How can we both enter into a deglobalized environment based on the political forces at work, while also ensuring that inflation does not get out of control? I'd love to get people's perspectives on what they see, maybe kind of shorter term, perhaps driven by policies and politics, and then maybe longer term, say looking out to the next, say the end of the decade. So go 8 years out to 2030. So short term, long term, and we'll start, Stephen, with you between those two.
I think what we're most likely to do is to go from globalization to regionalization. Every major economic zone actually desperately needs to have activities that can be performed nearby in low wage, low value added environments, because a lot of activities are just not viable. So if it's Latin America for the U.S., if it's Turkey and some parts of Eastern Europe for the Europeans, if it ends up being Vietnam and Cambodia and a few other countries for China, it's certainly not optimal, because we all took calculus. A universal optimum is better than a local optimum, and that's what we're going to be moving towards. It may not be the end of the world. I think that some of the other implications, could be worse. For example, if I were to say, look, I don't want any drugs from China, because I'm afraid, the supply might get cut off. It means I need more capacity here, but it also means, there's a reason the capacity is in China or in India or elsewhere, because it's much cheaper to produce. I have to be willing to pay the price, or else, have a mothballed factory which carries costs of its own here. So, and inevitably, the first company that does that is going to be the loser 9 years out of 10, because there's not going to be a supply shortage. Everybody's going to be trading, and the laggards in that process are going to be the ones with lower costs. So the political force will be to say, hey, look, we need a level playing ground. Let's let it happen, to make this extra capacity viable. And so it just builds on itself. I think the other part, and I don't want to quibble with Damian, I'm not to argue with him, but you look at things like EM and capital flows. I think there is a case for some countries having capital controls. If it turns out that there are waves of capital coming in and leaving, and it disrupts the macroeconomy, as long as the policies are basically sound, there is a case for stabilizing it. And it's not the end of the world. It won't be as, Washington consensus as, we once thought we wanted, but it's okay. I think the dollar in this world actually, becomes more difficult. It actually becomes Donald Trump's dream world, which is that you end up with a tendency towards forcing countries to have balanced trade. But because the deglobalization means, and obviously we've seen sanctions used and so on, if you're afraid that you're going to be at the losing end of a sanction, you're not going to want to hold the favor of the country that's likely to sanction you. And so how do you do trade at that base? On that basis, you kind of say, well, you send me flour, I'll send you wine. Or you send me Canada and the US, I'll send you hockey sticks, you send me baseball bats. And, but it's not, you don't have, you don't feel secure in terms of saying, well, I'll take those dollars and put it into the bank and kind of know that I'm good with it. And I'd say that, when we talk about the dollar, especially, there's one thing I think is clearly understood, that one of U.S.'s big exports used to be custodial services. Not custody, in the way that our Wall Street custodians did. But basically, the whole world had confidence that if they put the money in the U.S., it was good. They could access it. It wasn't going to be taken away from them. It was, no matter what happened domestically, they would have their nest egg in the States. It wouldn't be, it wouldn't be arbitrarily expropriated. I think once you start seeing, sort of capital flows and assets as kind of a weapon in either a trade war or a geopolitical dispute. And look, that might be absolutely the right thing to do, but your status as the world's safe haven custodian, that's gone. And, you sort of have to live like the rest of the world where, you sort of borrow money, you got to pay it back. It's not the security that people are always wanting to put the money there because that money will be accessible to you. That had a real value, and that's likely to dissipate over time.
Joyce, your thoughts?
Yeah, so I think you have to really ask the question, are there two supply chains? And are we going to leave the global manufacturing supply chain alone? So if you were just an alien looking at the US-China numbers, you wouldn't know there's a trade war. You had both exports and imports go up markedly. Some of that was from the low that had sort of been reached because of the pandemic. And you had foreign direct investment going into China reach an all-time record level. And so will the practicality and the reality play out that on the global manufacturing hub, you really can't displace China, whether it is the scale, the efficiency, the trained labor, the infrastructure, and will it be more focused? And you see this coming out of the U.S. rhetoric on what they call the strategic sectors. So where are the areas that really are critical for national security? Semiconductors, AI, life sciences, aerospace, and you see this out of the statements that are coming out of the Department of Commerce. Do we leave? We will remove and reduce some of the tariffs on bicycle parts, like low value manufacturing goods. So is there the rhetoric that we're all listening to, and then the reality that sort of the vast majority of trade, really may not be impacted that much? It will be more focused on these strategic sectors. But I think very much going to Steve's point, do you have a real sea change in the way one is looking at holding U.S. dollars, because of the sanctions? And it does seem to me when we look at the numbers, in China, that they really, the world is short commodities, but China has not. They have been stockpiling. So is it more of a shift to strategic resources and natural resources? So if you take a look at the numbers now, global copper supply, China holds 80% of it. 50% of wheat, 68% of corn, 26% of crude, has that become the new Bretton Woods too? That you're holding more resources, and that includes also just China's relationship with a lot of the low-income countries that Diego talked about that are resource rich, and they're also the largest creditor. So are we moving to a new sort of Bretton Woods 2 era, and will you see the supply chain really separated for practical purposes into sort of these strategic sectors versus global manufacturing? So
maybe in that sense, it's, this kind of gets into the next panel, which is more on solutions, but maybe one of the solutions is just stockpiling. So countries, instead of trying to create new capacity or new capability or change the supply chain, but just your stock inventories are increasing. Is that what you're suggesting, that could be part of the solution?
That you're looking at more holding strategic resources rather than dollars. That,
right.
You'd rather have commodity reserves rather than more dollars.
So perhaps I could just chime in here and support Joyce because I like her better than Steve. So basically,
that's not hard.
There's winners and losers, right? I mean, in every economic environment, right? So we know who the losers are. There's been a lot of losers to speak of, but who's the winner? I mean, I can pick one, Saudi Arabia. There's an economy with a 10% budget surplus, a 16% current account surplus. Their economy is going to grow above 1 trillion GDP next year. That's a 50% increase in 3 years. Okay, so to Joyce's point, yes, resources work. Now, is this the beginning of a commodity super cycle that floats all boats the way we saw, post-global financial crisis? I don't think so, personally. I think there's a lot of problems out there. I think the piping is broken. And, look, this all comes down to, and now I will agree with Steve because I always do, the dollar being king dollar, is that necessarily a good thing, even in the eyes of the U.S. economy? I mean, can the Fed really make decisions that are in the best interest of the U.S. economy when it has to worry about the rest of the world and what it's doing and the impact on it? And that's exactly what I'm hoping Chair Powell addresses in the presser that we're not listening to right now, because it's a very serious issue. And so, look, for me, I'm a practical guy. The reality is this world is denominated in dollars. It is. So we have to know that that's the blueprint right now. That's the playbook. It can change. It should change. Theta or time will only tell. And that can be a very long kind of duration trade.
Is it a foregone conclusion that the dollar devalues over time? Is that a fact, or to what extent may that not be true?
Stephen, you want to jump in there?
Look, I think over time can be over a long time, right? We're not talking about, certainly we've seen what's happened to the dollar. In a period of crisis, because all balance sheets are, or many balance sheets are denominated in dollars, that's what people go to, and it's the safe haven par excellence. I think longer term, there are different issues. And I guess I would distinguish between two things, where the question of, do you want to hold your assets in dollars if it's, uncertain whether you can use them freely as you expect it to? I mean, the answer is probably, let me think about that for a little bit. But the other question is, or issue, is that there's nothing that can match the depth and the liquidity of the dollar financial markets. And there's nobody that's even close to that. Not Europe, not China, not Switzerland, not any country you can think of. And as a consequence, people are still going to be forced to do it. But I'd say the store of value function of holding dollar assets, that's going to become increasingly under question, and probably put some downward pressure on the dollar.
Let me add one other thing, because there's always a lot of talk about, shifting to the yuan as another reserve currency, or, whatever. There was just recent talk about the GCC doing another basket, not pegging to the dollar, but pegging to a basket of currencies. When you're trying to move around treasuries in the secondary market in today's day and age in that size, it does not happen overnight, and the whole world knows it's you. And so from a practical standpoint, does the PBOC, China, does Salmon, Saudi Arabia, do they want to move treasuries in that size when the whole world knows it's them moving to some new basket? Maybe not the best idea. So my point is, from an empirical standpoint, while I agree with a lot of what we're saying here, and yes, in time, yes, the dollar cannot, this is just not healthy, right? I agree with everyone, diversification works, so eventually over time, it will kind of move in that direction. But the world is, as Steve points out, so conditioned to the dollar that to break that, it just doesn't happen real easily.
Yeah, in the near term, I see no prospects for that. And when we're asked about renminbi internationalization, that actually peaked in 2015, before China revalued the currency, and it hasn't increased even as you've seen. The IMF SDR basket includes, for instance, if you look at China's own trade, and 80% of it's in dollars. So there's a lot of talk about this, but what are the practicalities? Are you going to go into yen?
Right.
You've got euro dollar at parity. You've kind of already de-anchored, like cable, right. And so there just aren't other options right now. But would you rather not just hold only dollars, but actually have some strategic, like commodity reserves?
All right, so we
just point one thing, that a lot of the oil exporters talk diversification and long term. Chase the highest yield.
Okay, it is now 3:30. We want 5 more minutes. We want today to be very interactive, so we're going to have pass these mics around to everybody here to have 10 minutes of Q&A. So, but we have 5 more minutes. But I want to cover let's go a little bit back to globalization and deglobalization, which we know is to some extent a foregone conclusion given everything that's happened with COVID and with the war in Ukraine and so forth. Where are we at the end of the decade? So in 8 years, if you had to sort of summarize how globalization will change, what's the new deglobalized world? I'd love to get everyone's just sort of 1 minute perspective on what the world looks like at the end of the decade. Steve?
I think that when we talk to our grandchildren, and explain to them what 2019 looked like, how free capital mobility was, or even then how much trade there was, ability to get around and the lack of baggage in terms of trade flows and capital flows, they won't know what we're talking about. I guess institutionally as Standard Chartered, we're, this is our world and we thrive on it and we do it very well. But I'm a little bit pessimistic that there's big hope for globalization. I think that it will be the case that, if you ask 100 people how much globalization will retreat, their estimate is probably too high. But I think there are kind of important dimensions in which it's going to go. So I'd say the regional stuff is likely to be what we see more, and the global stuff is going to be kind of.
Can you give a couple of examples of where deglobalization will be most pronounced?
Look, I think that the efforts at identifying strategic products and trying to be independent in their production, I think that those are going to continue. I think the definition of what a strategic product is going to be very political in some cases. But I think that we won't be able to escape that. And one last thing, increasingly, I think worries about who do I want to accept into my graduate school to study advanced chemistry or physical chemistry or something. That's going to be.
Joyce, your thoughts on?
So I do think we're leaving this era of the great moderation, and we're going into what I would call a period of stop-go cycles. And it's not just about globalizations; it's a combination of all of the geopolitics as well. That it's become geo-economics. But I think what that means is slower growth. And some of that's because of the demographics, higher inflation, higher volatility, which higher inflation brings. And, to the point that Diego brought up, I mean, lack of market liquidity as well. You basically have shorter cycles. So if, it used to be that an expansion and a recession was 10 or 11 years on average, are we talking that that's more half of that amount now, 5 years? And it is more of these stop-go cycles, and we've ended the 40 years that we went through. So, at the end of the decade, we do think U.S. Treasury yields, looking at sort of a, inflation at 3 to 4% will be 5.5%. We think this period of, just this lower for longer period is one where we're, shifting, out of that. But we're doing this with, the enormous debt levels, fiscal burdens that we have built up. And that does point to slower growth. So a period of slower growth, higher inflation, more volatile cycles, and shorter cycles.
Yeah, I mean, for me, it's it's academic to look out past 12 months in this market for sure, and in my view, certainly. I mean, I think if you did have to look out past that out to 10 years, it becomes about two things for me: demographics and geography. Those are the only two finites in this world, right? I mean, there's so much geopolitics, there's so much noise. So based on demographics and geography, I think it's pretty obvious that there's going to be a lot more people on this planet. And this is going to take a lot more labor in other places to feed them and house them and care for them over time. So globalization is going to increase over, the future. There's no question about it, just based on the demos. And look, I mean, we talk about reshoring and we talk about geography, but really, is Latin America that much closer to the United States than some other parts of the world? So I mean, geography, while I agree it's a fixed asset, it's a piece of real estate, but I think it becomes more a question of resources and who has them and who's equipped to extract them and deliver them to the rest of the world. So yeah, I mean, I think based on those two kind of big drivers, globalization is not going away. It's just taking on a new shape and form.
All right, so you've heard it here. A lot of window dressing, not so many changes. Inflation, our GDP, it's sort of 5.5%, and our Treasury at 5.5% over the next 10 years, but not too different from today. Is the state of things. We'd love to get some questions. We want to make this very interactive with the audience. So, Stephen. This way I'll be recorded. Be careful what you say to be recorded.
I'll clean it up. Can you hear me with this thing?
Yeah.
Okay.
Can't hear so, but they
The conclusion I'm coming to, which I probably knew before, from listening to your comments, is that globalization, like climate change, was approached from a poorly managed standpoint. The methodology wasn't controlled. The same thing is occurring with globalization, with climate change. You have ideological approaches. Now, we're not saying that there isn't climate change. We're not saying that globalization doesn't have tremendous benefits. But if it's not approached managerially, both from a political standpoint, governmental, and economic, and if you get down to the micro level, corporate level, you end up destroying the very benefit, because the majority of the people are going to be hurt by these actions or lack of management of these circumstances. And we're going to start importing and taking out of mothballs the guillotines that the French used in various parts of the world, if not here. Because when you have economic problems that become significant, look around, look at history, what's happened. So you have beneficial circumstances that could have been better controlled. So you could control the supply chain better, you could have controlled the consequences of globalization and mitigated the negatives, unemployment, et cetera, et cetera. Because look at the consequences now, what we're talking about. You're talking about inflation, you're talking about many other circumstances that now are going to be negative. That if managed properly would have been positive. Easy to say, by the way, hard to do.
So is there a question in there or just the comment?
It was really a comment, but I was trying to draw a conclusion. I mean, the question is, what are your thoughts on this globalization issue in the sense that can it be resurrected in a way that benefits, managerially resurrected, so that you avoid the problems? That would be the question.
All right, who'd like to take the answer for that one? Not all at once. Stephen, go ahead.
Yeah, look, any process that you do, if I look back at the decisions I've made over my own life, I think I could figure out some better outcomes, with 20/20 hindsight. And nobody 20 or 30 years ago knew the path that globalization would take. And, including things, U.S. probably made some mistakes. I think there was an expectation that, the Chinese financial markets would open up more quickly, maybe have more flexibility, and that didn't pan out the way people expected. It wasn't, there's plenty of surprises on every side there. But I think, I'm going to St. Louis tomorrow, and St. Louis, it's going to be 91 degrees. Thank God that you can buy an air conditioner, or used to be able to buy an air conditioner for $200. Without globalization, you're going to have to open up warehouses that are air conditioned, for people to go to. I really think it's, because you see people on the street, it's easy to see the negatives. But I think there are a lot of positives.
So price is king, right? It's deflationary, and so those forces at work are going to keep globalization open because of the need for price control. Another question from the audience. Ready?
Yeah, I think somebody mentioned Turkey. I think it was you, Damian. You mentioned Turkey. I think one thing with globalization has been the funds flow. The volatility of funds flow can cause a lot of chaos in the countries. Turkey being the perfect example of how they fund their deficit. So what I get a feeling that, the globalization is obviously good. I benefit from that. Is that if the supply of capital is more steady for these countries. Otherwise, if it's just money in, money out, quickly, it's very brutal, very painful. I've traded in Argentina. I've seen what happened there with 2003 and other countries, right? So does anybody have any suggestions of how to ensure longer-term capital commitment, and make more incentives for that, rather than 90-day T-bills, highest yield in and out?
Sure, I'll take a stab at that. Sure.
It's not that bad, but
I mean, this is. The first thing to address Turkey, and I think it kind of, just to compare it to your colleague here who just made the statement that globalization was managed inappropriately based on ideology. That's kind of what we're seeing in Turkey, right? I mean, to some extent. So, and I can make the same comparison to the fact that previous U.S. administrations believed that every U.S. citizen should be able to own and live in their own home. I mean, it just doesn't work out that way. It's an ideology, right? Or have access to healthcare. I mean, I would love for everyone to have it, but that's not the world we live in. So just addressing that, but I think to your point about how do you create stickiness inside of domestic markets for foreign investment? Well, I'll tell you right now, I'm not opposed to capital controls in many instances, right? What I am kind of suggesting is look at where the world is from a fund manager's perspective here in the US, and how that shift to private credit and private equity and fund managers who mark their books 4 times a year, if that maybe a year, relative to a manager who marks 12 times a year, right? So what you're talking about is creating a structure that allows people to mark their books or mark their investments in a way that perhaps doesn't completely, on paper at least, force them into an issue where they're a forced seller, right? It's hard to do. I mean, Egypt is doing a good job at it now in terms of drawing in money at the short end of the curve and slowly building their yield curve out, right? I mean, you've got foreigners who now own 2-year, 5-year debt in Egypt in pounds. I mean, look back to the Arab Spring, we weren't even close to that, right? And certainly I get your point on foreigners, fast money investors renting in the short end of a lot of these curves and then leaving very quickly when all things are off. And in those instances, I agree with you. Some level of capital control, some level of penalty, be it tax related or what have you, is certainly in order to sort of maintain a commitment. But I think, unfortunately, for the world we live in, the demand for dollars has become so great that a lot of administrations in emerging and foreign markets have really chosen to overlook that because they need those dollars in order to survive. Again, back to Turkey, look at the banking sector. So, I mean, you look at Garanti, you look at Akbank. I mean, I know them all. You know what's gone on with a lot of these banks, and their external debt load is pretty huge, right? So I think, it's about credibility. It's about prudence, I think, for me. And that's the key here. If you have a credible administration that's, got some level of policy-making authority, you stand a better chance than most.
Okay. One more question. Behind you.
Thank you.
Hello.
It's on.
Okay. To somewhat counter both of your arguments, we do a lot of foreign direct investment in both emerging markets and frontier markets. If you're not able to exit your investment because of regulation, because of taxation, what's the incentive for you to invest into those countries? I mean, you don't want to potentially stay there forever, right? I mean, even if you're like us, a foreign direct investor, at some point you do want to exit. And if that country makes it very difficult for you to exit that investment, well, you're going to, if you were a smart investor, you're going to stay away or wait until the political situation, taxation, and so forth changes.
All I'm suggesting there is you structure the investment on the way in where you have a exit. You have a 7-year window, or you lock it up for a period.
That can change. I mean, I'm not going to give you specific examples, but I could tell you in our situation with one big country that most people know about, they changed the tax laws, would not grandfather us in. We're still fighting them in tax court 8 years later.
Of course.
And we're not the only ones. There's other foreign direct investors who have the same problem. So things change, sure. When we went into these companies decades ago, sure, the regulations, we structured them accordingly. but like things change in this country, right? Laws change, taxation changes. It's kind of hard to anticipate every particular change in some country's tax regime. And my point is, unless you make it friendly for foreign direct investment, and even I think in the funds as well, it's, why should we put our dollars or our investments in those countries?
Well, I think if I can just answer your question, I wasn't suggesting that you put capital controls, but.
This gentleman was.
Well, I
think we need to define what a capital control is. All I'm saying is I'm not saying that a government should be able to slap up should be able to slap up the gates on an investor at their whim. And we all know that happens in a lot of markets. All I'm saying is there needs to be a smarter solution to how you can invest long-term in an economy.
Like Chile had withholding tax for short-term debt.
Like Ghana, like many markets who basically tax you if you remove your money after a certain period. You can remove it subject to a penalty. I mean, there's a lot of different capital controls, which doesn't mean we block the gates on you and you can't get your money out. I'm not at all suggesting that, to be very clear.
Yeah, and look, I don't think capital controls fixes bad economic policy. It probably makes them worse. They can go further. But in the case where the policy is fundamentally okay, they can, you can take measures to try and stabilize the flows, and you can make the case that those are worthwhile.
Yeah, and I think that the whole point is that they're selective and sort of as needed under certain circumstances. Correct. I mean, you need to have the right policies that are in place. But one thing I just wanted to add to just the discussion is just the overall comments on where market liquidity is today, because we would just say that it's probably 30% below where it was pre-pandemic across all major markets, whether it's treasuries or tips or the S&P 500 or the FX market. So the amount that you can actually transact and the market movements and the oil market now too are exaggerated as far as the sensitivity. So I mean, you think about the treasury market and that has grown fivefold, and the intermediation is exactly the same. Right. And so what you have seen is this trend since the global financial crisis where, companies are staying private longer. So if the whole point of being public was that you'd have the liquidity in a downturn, that's not the case. So the number of public companies in the U.S. peaked in 1996. And the number of private companies has gone, 70, it's gone from 7,300 to 4,800 in the U.S. And the private companies have gone from 1,600 to, over 10,000. So market liquidity makes a big difference for, what the whole arguments for some of these markets where they would be more liquid. So in a crisis, you could get out of these markets. If that's less the case, you will see companies staying private for longer, not wanting to go through this. And you're going to have to really sort of look at which markets are tradable in this environment.
All right, so I think we'll leave it at that. Thank you all. Wonderful discussion. We've gotten onto a number of different points, but all very, very interesting. The next panel is going to be on solutions. What can we do in this very challenging environment to actually identify solutions to deglobalization, where it's headed? And we're going to pause now for 10 minutes and have a break. So encourage everybody to grab some coffee or snacks, and we'll see you in 10 minutes. Thanks so much.